Gold has been considered one of the world's most valuable assets for thousands of years. Empires have accumulated it, central banks continue storing it, and investors across generations have relied on it during times of economic uncertainty. Despite the rapid growth of technology stocks, cryptocurrencies, and other modern investments, gold remains one of the few assets that consistently attracts attention whenever financial markets become uncertain. In recent years, gold has once again become a major topic of discussion, as prices have reached historic highs, central banks have accelerated their purchases, and institutional investors have increased their exposure. Many experienced investors, often referred to as smart money, appear to be positioning themselves before broader public interest returns. This has raised an important question. Why are professional investors buying gold before everyone else? While no investment guarantees profits and future prices cannot be predicted with certainty, there are several economic, financial, and geopolitical factors that help explain why gold continues attracting sophisticated investors. Understanding these reasons can help individual investors make more informed decisions rather than simply reacting after major market movements have already occurred. Today we will talk about why smart money is buying gold before everyone else. Before we start, make sure to hit the like button and subscribe to my channel. Understanding what smart money means, the term smart money generally refers to experienced institutional investors, hedge funds, central banks, professional portfolio managers, family offices, and highly knowledgeable individuals who manage substantial amounts of capital. These investors often conduct extensive economic research before making investment decisions. Rather than reacting to headlines, they study inflation, interest rates, monetary policy, government debt, global trade, geopolitical developments, and long-term market trends. Their investment decisions are usually based on careful analysis rather than emotion. Gold has preserved wealth for centuries. One of the primary reasons experienced investors continue buying gold is its remarkable ability to preserve purchasing power over long periods. Unlike paper currencies, which can lose value due to inflation or excessive money creation, gold has maintained its role as a store of value throughout history. Although gold prices fluctuate over shorter periods, it has repeatedly demonstrated resilience during economic crises, financial instability, and currency depreciation. This long-term reliability makes it attractive for investors seeking wealth preservation rather than rapid speculation. Inflation remains a major concern. Inflation continues influencing investment decisions worldwide. When prices for everyday goods and services rise faster than incomes, purchasing power gradually declines. Central banks often attempt to control inflation through monetary policy, but inflationary pressures can persist for extended periods. Many institutional investors purchase gold because they believe it may help protect portfolios against the long-term effects of rising prices. Although gold does not always move perfectly alongside inflation in the short term, it has historically been viewed as one of several assets capable of preserving value during inflationary environments. Central banks continue accumulating gold. One of the strongest signals attracting investor attention is the continued accumulation of gold by central banks. Countries around the world have been increasing their official gold reserves at historically significant levels. Central banks hold gold because it provides diversification, strengthens national reserves, and reduces dependence on foreign currencies. Unlike paper assets, gold carries no credit risk because it is not another institution's liability. When governments responsible for managing national financial systems continue purchasing gold, many investors view this as an important indicator worth monitoring. Growing government debt creates uncertainty. Government debt has increased significantly across many major economies. Financing this debt often requires continued borrowing, refinancing, taxation, or expansion of money supply. While governments have various tools available to manage fiscal challenges, high debt levels sometimes create uncertainty regarding long-term monetary stability. Gold often benefits during periods when investors seek assets independent of government-issued currencies or debt-based financial systems. Gold performs differently from many financial assets. One reason professional investors include gold within diversified portfolios is that its price drivers differ from those affecting stocks and bonds. Corporate earnings primarily determine stock prices, while interest rates heavily influence bond values. Gold, however, often responds to inflation expectations, currency movements, geopolitical uncertainty, central bank activity, and investor sentiment. Because these factors differ, gold may help reduce overall portfolio volatility during certain market conditions. Geopolitical risks continue increasing. International conflicts, trade disputes, sanctions, political instability, and military tensions create uncertainty within global financial markets. During periods of heightened geopolitical risk, investors frequently seek assets considered relatively stable. Gold has historically attracted safe haven demand because it remains valuable regardless of political developments affecting individual countries. Smart money often begins preparing before geopolitical risks fully affect broader financial markets. Currency diversification matters. Most global trade and financial assets remain heavily connected to major reserve currencies. However, professional investors often seek diversification across multiple asset classes to reduce concentration risk. Gold provides an alternative that exists outside traditional currency systems. While it does not replace cash or productive investments, it offers diversification that many institutional investors consider valuable during uncertain monetary conditions. Gold supply cannot expand rapidly. Unlike paper money, which governments can create through monetary policy, gold supply grows only gradually through mining. Developing new mines requires years of exploration, environmental approvals, financing, and construction. This limited supply contributes to gold's long-term scarcity. If demand increases while supply remains relatively stable, prices may experience upward pressure over time. Interest rates influence gold prices. Interest rates play an important role in gold markets. Because gold does not generate interest or dividends, higher interest rates may reduce its attractiveness compared to income-producing investments. However, if investors believe higher rates will eventually slow economic growth or contribute to recession, gold demand may increase as investors seek financial stability. Smart money often evaluates not only current interest rates, but also expectations regarding future monetary policy. Institutional investors focus on risk management. Professional investors understand that successful investing involves managing risk rather than simply maximizing returns. Gold often serves as a form of portfolio insurance. While it may not always produce the highest returns during strong economic expansions, it has historically provided protection during periods of market stress. Institutional investors frequently allocate modest portions of portfolios to gold precisely because they recognize that financial conditions can change unexpectedly. Gold is not about chasing quick profits. Unlike speculative investments promising extraordinary short-term gains, gold generally appeals to investors seeking stability, diversification, and long-term wealth preservation. Smart money rarely purchases gold expecting overnight riches. Instead, these investors recognize gold's role within broader portfolio management strategies designed to perform across various economic environments. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.